Welcome back to the Daily Crypto Roundup. Today we're looking at a market that has slowed down and pulled back slightly, rather than continuing the straight-up move we saw earlier in the week. Bitcoin has retreated from recent highs and is now trading closer to $95,000. Ethereum is hovering around $3,300. And across the rest of the market we're seeing a lot more two-way price action. Profit-taking on strength, cautious buying on dips, and generally a more defensive tone. That's an important shift, because this doesn't look like panic or breakdown. It looks like consolidation. The kind of pause you often see after a strong move, where the market takes a breath and decides what it wants to do next. So today's roundup is about understanding why the market has cooled off, what's actually driving this pullback, and what it tells us about the week ahead. Before we get into it, quick reminder. We're still running the XRP giveaway. So if you've got thoughts on the market or today's episode, drop a comment and you'll be in the mix. Let's start with prices so everyone's grounded. Bitcoin is currently trading just under $95,500, having pulled back from resistance in the mid-$90,000 range. Ethereum is sitting around $3,300, holding above recent breakout levels but clearly struggling to push higher right now. XRP is trading near $2.05, Solana is back around $140, Binance Coin is near the mid-900s, Cardano is hovering just below 40 cents, and Dogecoin is holding around 13 cents to 14 cents. The key takeaway here is not that prices are down slightly. It's that they aren't collapsing. We're not seeing forced selling, cascading liquidations, or a rush for the exits. Instead, the market looks like it's digesting gains, with traders reassessing risk after a fast move. One of the reasons analysts aren't reading too much into this pullback is the way the market is behaving structurally, not just where price is. In unhealthy markets, pullbacks tend to accelerate. Bids disappear, liquidity dries up, and every small red candle invites more selling. That's not what we're seeing here. Instead, the market is slowing down, volumes are tapering, and price is moving sideways rather than down sharply. That kind of behavior usually points to distribution of short-term positions, not long-term exit. Several technical analysts have highlighted that Bitcoin is still trading above key short- and medium-term moving averages, which suggests the broader trend hasn't been broken. Momentum indicators on higher time frames have cooled off without flipping decisively bearish, and that's exactly what you'd expect after a strong move. Markets need time to digest gains. When they don't get that time, that's when things tend to break. There's also an important difference between a pullback driven by forced selling and one driven by choice. Forced selling shows up as liquidation spikes, rapidly expanding volume, and aggressive moves through support. What we're seeing now looks much more like traders choosing to de-risk slightly, lock in profits, and wait for the next signal. That's a sign of maturity, not fear. From a broader cycle perspective, analysts often point out that sustainable trends are built on acceptance, not excitement. Price moves higher, stalls, lets participants reposition, and then either continues or fails. Right now, the market is in that acceptance phase, not euphoric, not panicked, just undecided. And undecided markets can resolve in either direction, but they don't usually collapse without a trigger. So why has the market pulled back? The first reason is simple and healthy: profit-taking. After a strong rally earlier in the week, especially in Bitcoin and Ethereum, it's normal for short-term traders to lock in gains. That selling pressure doesn't mean sentiment has flipped bearish. It just means some participants are stepping aside after getting paid. Second, macro uncertainty has crept back into the picture. While inflation data has cooled and longer-term rate expectations remain supportive, traders are now waiting for confirmation rather than charging ahead. With key macro data due later in the week, including the Fed's preferred inflation gauge, markets are reluctant to price in aggressive upside until those numbers are out. Third, there's been a subtle shift in risk appetite. Earlier in the week, we saw rotation into altcoins and higher beta assets. Now that rotation has slowed, and capital is flowing back toward the larger, more liquid names. That's a classic sign of consolidation. Not fear, but caution. On-chain data supports this interpretation. Exchange balances for Bitcoin remain relatively low compared to recent months, suggesting there's no rush to sell en masse. At the same time, whale accumulation has slowed slightly after heavy buying in December and early January. That doesn't mean whales are dumping, it just means they're waiting. Ethereum's behavior is also worth watching closely. It breaking above $3,300 was constructive, but recent sessions show momentum fading. Some large holders have been taking profits into strength, which helps explain why it hasn't pushed higher yet. Importantly though, Ethereum has not broken down. It's holding its structure. Analysts often point out that failed rallies collapse quickly. This one hasn't. The relationship between Bitcoin and Ethereum is particularly important at this stage, because it often tells us whether the market is transitioning from caution to confidence. Bitcoin tends to lead moves when liquidity first returns, acting as the safest expression of crypto exposure. Ethereum usually follows once traders feel comfortable stepping slightly further out on the risk curve. That's why its recent strength matters, and why its current pause matters just as much. Right now, Ethereum is holding above levels that were resistance just weeks ago, even as momentum cools. That's constructive. Analysts often look for Ethereum to either break down quickly after failed breakouts, or consolidate sideways if the move has substance. So far, we're seeing consolidation. That doesn't guarantee continuation, but it keeps the door open. Another subtle but important factor is where activity is happening on Ethereum. While some large holders have taken profits, staking continues to rise, and the exit queue remains light. That tells us long-term participants are not rushing for the door. Short-term traders are adjusting positions, but longer-term holders appear comfortable sitting through volatility. If Ethereum can stabilize and begin to regain relative strength against Bitcoin later in the week, that would signal a renewed willingness to take risk across the market. If it can't, and instead continues to lag while Bitcoin holds up, that would suggest this remains a Bitcoin-led environment, not necessarily bearish, but more selective. Either outcome is useful information. What would be concerning is a sharp loss of support alongside rising volume, because that would suggest risk appetite is evaporating rather than pausing. Altcoins are feeling the pullback more than Bitcoin and Ethereum. That's normal. In consolidations, higher risk assets usually give back more. We're seeing selective weakness rather than indiscriminate selling, which suggests traders are managing risk rather than abandoning positions. Now let's talk about sentiment, because this is where things get interesting. Despite the pullback, sentiment hasn't flipped sharply bearish. We're not seeing panic posts, extreme fear readings, or mass liquidation cascades. If anything, sentiment looks uncertain, and uncertainty is not a bad thing for markets. Historically, strong uptrends don't begin when everyone is confident. They begin when people are cautious and waiting for confirmation. Analysts have been pointing out that funding rates remain relatively neutral, meaning traders are not piling into leveraged longs. Open interest has come down slightly alongside price, which suggests excess leverage is being cleared rather than built. That's constructive from a structural standpoint. So where does that leave us heading into the rest of the week? This is where the market faces its next test. The bullish case remains intact as long as support holds. For Bitcoin, the low to mid $90,000 range is the key area to watch. As long as price stays above that zone and avoids sharp high-volume breakdowns, consolidation is healthy. For Ethereum, holding above the $3,200 to $3,300 area keeps the structure constructive. What would be concerning is a fast move lower, especially one driven by rising volume and renewed leverage. That would suggest the market isn't ready yet. But that's not what we're seeing right now. Macro events later in the week could add volatility. Inflation data will matter. Central bank commentary will matter. And with traditional markets closed early in the week for a US holiday, liquidity may be thinner, which can exaggerate moves in crypto. There are also token unlocks scheduled over the coming days, including a very large unlock for Ondo Finance and a significant team allocation unlock for the Trump token. Historically, events like this can create short-term selling pressure, especially if recipients choose to take profits. So the right way to think about the market right now isn't pump or dump. It's pause and assess. This pullback does not automatically mean the rally is over. In fact, many strong moves begin with a pause like this. What matters is how the market responds to stress, whether it absorbs selling or fractures under it. Right now, it's absorbing. That keeps the broader picture constructive, cautiously, but clearly. As always, don't chase green candles. Don't panic on red ones, and let the market show its hand. Drop your thoughts in the comments, make sure you're in for the XRP giveaway, and let us know what you're watching this week. Thanks for listening, and as always, we'll see you at the top.